Hi guys, this is Andreas Steno sending to you live Thursday, December 15th. I am live all week at the Real Vision daily briefing throughout this interesting week in central bank space. And therefore, we are going to ask the question today, have central banks ruined Christmas? We are basically swimming in a sea of red in markets today. NASDAQ down more than 3%, and it looks red across the boards, even in bond space in Europe, where we had the European Central Bank out with a very hawkish message earlier today. So we need a steady hand to guide us through these troubled waters. And I know a steady hand out there, namely Tommy Thornton, the founder of Hedge Fund Telemetry. It's a great pleasure to have you back at the daily briefing, Tommy.
Well, thanks for having me, and I'll do my best to try and stay steady. It's a very, very difficult market. It's been that way all year, and I know there's a lot of people that have basically said, I'm shutting down, and they've packed it up for the rest of the year, which is probably not the worst idea. I'd like to do that, but I'll be here every single day, knocking it out just like I always do.
Tommy, I know you watched the European Central Bank earlier today, and staying in this Christmas mood, I want to ask you initially, did Christine Lagarde just play the role of the Grinch ahead of Christmas here?
She was a very tan Grinch, but I'll tell you this. I don't think I can remember a time where the ECB has ever been this hawkish. And if they've ever given some sort of hawkish comment, they will, they'll do something else like they'll lower rates and, a quarter point or something here and there. Do something, it's a passive aggressive approach that the ECB has always taken. So as we were talking briefly before, you said it was a very odd meeting. And I think it's odd because I don't think you guys have ever seen the ECB truly come out and out hawk the Fed. And that's what I think Christine Lagarde did. She was direct, really hit the markets hard, and especially I'm watching the Euro stocks, 600 and the 50, just brutal. The DAX, everything just was massacred, and everything's been sort of consolidating at the highs. It's had a nice run, and she just knocked the legs out.
Yeah, indeed. And if I were to highlight a few things from that ECB meeting, I want you to take notice of the inflation forecast from the ECB. They actually expect the core inflation in Europe to be at 4% in roughly a year from now. And I guess that is why they now hint of interest rates going to plus 4% territory, because as Powell has said, we need interest rates above the core inflation to bring inflation down. And I mean, if that is the case in Europe, that they really intend on bringing interest rates above 4%, oh boy, the fixed income market needs to reprice massively from here. We still have, for example, the German 2-year bond yield just trading just above 2%, for example. I think you can bring up the chart on that, Brian. We had a reaction of a bit more than 20 basis points in the 2-year German note, but we're still far from the 4%, if that is the true aim of the European Central Bank. But I wanted to bring the discussion back to the price action in markets surrounding this European Central Bank meeting. As I said initially, we are swimming in a sea of red today, Tommy. What do you make of the price action, also technically speaking, in European and US equity markets?
Well, 3,900 for the S&P and the Euro Stoxx 50 have both been levels that I've been watching. And if you go back to November 10th, when the CPI was released in the US, the markets gapped up higher and continued to move. And it's tested that 3,900 level around where it opened. And it's tested it about 3 or 4 times. And today it finally broke, and the NASDAQ as well broke down from those levels. So all the people that have bought in the last month are starting to see their portfolios turn a bit negative. And you're not necessarily seeing it in the last 5 days, but you're seeing the month returns start to turn negative on my screens. And nothing, in my opinion, motivates sellers more than when they start to see losses and red in their portfolio. So if we see the markets dislocate a little bit more and break those, that 3,900 on the S&P, we could have an air pocket of about 3 to 5% lower. And look, it's holiday season. A lot of people are going to be traveling. Liquidity is terrible. So I think there's real risk. There's no more catalyst for the rest of the year. I mean, we have option expiration tomorrow. It's a big one. It's a December expiration, one of the bigger expirations of the year. And we could see some dealers unwind some of their hedges. I think there was, essentially the lower we go below 3,900, they're going to have to sell a lot quicker and faster to remove their hedges, because I think there was a lot of call buying going into this week, especially with the CPI. Maybe not as much as we saw a week ago last Friday when the PPI came out and surprised the markets with a little hotter report. But the bottom line is, okay, good. The CPI is showing the inflation is starting to reverse. I see a lot of analysts that are saying it's plummeting. I wouldn't call it plummeting yet. And I think that the Fed and Powell, they're saying, look, we need to get the terminal rate higher. They moved it, their dots to 5.1%. It could go even higher. And look, when the markets are up, it gives the Fed more ammunition to continue to raise rates. And even if they stop raising rates, they're not necessarily going to pivot and cut rates. I think that would be a bad policy error in the sense that they're trying to reduce their balance sheet at the same time. So if they did that, it would be counterintuitive to what their true plan is.
Tommy, right after the CPI report a couple of days ago, you tweeted, "This was your early Christmas gift to sell." Yeah. And oh boy, you've been right. What made you so certain that this was a perfect timing to sell into the rally?
A couple things. One, I didn't think it was that great of a CPI report, and a lot of people were saying the number leaked and markets took off a minute ahead of the report. And I don't know, maybe that's true. Next time, I hope someone will, tip me off. And but the point is, I look at DeMark indicators and their exhaustion indicators, and we had not only the exhaustion on the daily for the S&P and OEX and VTI and several other key indices that I've been anticipating. We also had them on the shorter term time frame, which is the 60-minute tactical time frame that I use. And the DeMark indicators are exhaustion indicators. There's other indicators that Tom DeMark developed. I will say that the Real Vision piece that Raoul did with Tom DeMark is excellent. I highly recommend everybody go check that out. It's well worth watching if you're interested in learning about DeMark indicators. On hedge fund telemetry, I try to explain every day how they work, but truly they're indicators that I've used for 20 plus years, and I'm still, grabbing a book and trying to figure out, oh, that's how it works. That's why that did that. So it's just that they're sophisticated indicators. One thing that I will say, Tom DeMark started developing these indicators before computers, and he did them on paper. And this is in the 1970s. He worked with Larry Williams and other people that I swear, how he created this. When they work, they're fantastic. And we also know when they don't work, we know that that's telling you something too, that the trend is very, very strong. So yeah, definitely go check out the Real Vision interview with Tom DeMark and Raoul. I think it'll be eye-opening for a lot of people.
Tommy, you sent us a chart before we went on air on the S&P 500 with a so-called DeMark sequential sell countdown 13. So please speak to this chart and why it is such an interesting signal to watch.
Okay, well, essentially, there's two phases in the DeMark sequential. There's the setup, which goes to 9, and if it continues after that, then you can have the red sequential countdown, and that continues the trend. We tend to look for both the 9s and 13s. The 9s tend to be sometimes a little shorter term, sometimes more range bound. But when you do get the 13s, it's a really significant exhaustion signal where one should expect a price reversal within the next 10 days or 10 bars, depending on your time frame of how you're looking at it. So we had this happen with the spike higher, and then today it reversed down, and which is a nice start to the price reversal that we were anticipating. Now, where it goes is your guess is as good as mine. I don't rule out going to new lows. We're coming into the next phase of this market pullback where I believe it'll be more based on earnings declines. So I think that is really the key that we're going to have to be watching for pre-announcements and misses and weak guidance. I mean, if you're sitting there after hours, take time, listen to some conference calls, get the tone of what CEOs and managements are saying. I think it's beneficial.
Tommy, speaking of earnings, you wrote to me earlier today that you have your attention focused on Apple and Tesla in terms of earnings. So why don't you speak to this point? What is it that makes you so interested about those exact two companies? Do they set sort of a guidance for the broader tech company, sort of the broader tech stock space?
Well, they're two of the largest companies still in the market. So obviously Tesla's been, cut in half after this year. But I'll speak to Apple first. I think that with the disruptions that have happened in China, I believe that will translate into a weaker number. And I'm not quite sure that the China reopening story is going to be as smooth as people expect. I don't think that China has, it's a much larger country, many more people, and I don't think it's going to be as smooth. So you could see some hiccups there. But Apple, there's a big debate whether it's production issues or is there a demand issue. And I would say that going into a recession next year and people's incomes are lower because of the, consumer discretionary spending is going to be weaker. We saw retail sales weaker today. You just may not see the upgrade cycle for the iPhone 14. I mean, it's a nice phone, better camera, a little thinner. I don't know if it's thinner, but it's got a better battery. But that's kind of what every single upgrade has been in the last several years. So who really needs to spend that much money? I don't think it's going to happen. And so for Tesla, look, I think it's a real mess for Tesla shareholders. They have their CEO who I think a lot of us have known he's a pretty much unhinged type of guy. It was cute and fun when the stock was going up, his antics on Twitter, but now he owns Twitter. He's doing reputational harm for Tesla with some of the things he says and does. And I don't think that I think his concentration is really more on Twitter versus Tesla, where Tesla is at a really important place right now. They've opened 2 new factories. Demand may be slowing there, and that's been my big call, that demand will slow. We're going into recession. They have 2 new factories. The factories, as Elon Musk called it, money burning furnaces. I think it's a tough quarter for them. In China, again, they have some issues. Maybe it's demand, maybe it's production, but I think the company is in trouble. The stock is down significantly. It was down 12% this week. We found out that Elon Musk sold $3.5 billion worth of stock. Why is he selling stock at the lows? I don't know. Could be to pay off some of the Twitter bond fiasco, which I think Morgan Stanley is going to take a big hit on because they're holding some of that paper that's not doing well. And it could be for other things. It could be to pay for running Twitter because that loses money, and they're probably losing more money since he's turned off a lot of advertisers significantly. And I think that you're starting to get shareholders are starting to get restless. I think that if they come out with weak earnings, In January, I think a lot of people are going to say, you know what, I've had enough. And I think that's, again, these are, Elon Musk has made a lot of unforced errors over the years. The fake buyout, the other stupid things that he said on Twitter, and things that have never materialized that he promised that, are coming in the next 6 months, autonomous driving, blah, blah, blah. He makes unforced errors, and he's making a lot of them right now. So I'm short the stock. It's not that hard to be short right now. It can bounce around. It's not the easiest stock, but certainly I think that I see no reason to cover.
Tesla is certainly not doing well in equity space right now, but the big question, Tommy, is whether this is a bellwether for the broader tech sector. Last time we spoke, you leaned short on the tech sector in general terms. What about now?
I'm looking over at my screen right now, and I see Adobe is trading up 5%. I shorted it yesterday, so I'm basically round tripping it. I don't know what the numbers are or what the guidance will be, but it's not a big position, and I still think that there's a lot of risk out there. So it's, come see, come saw. It happens. I'm not too concerned. I think that still semiconductors, if we go into a recession, are not a good place to be. A lot of them are beat down, but I still think semiconductor capital equipment is overdone or is still very elevated, and they're being cut off from a lot of Chinese companies that like to buy their equipment. So I still think there's risk there. I think there's risk in financials. You don't necessarily want to be long financials into a recession. It's not a good place because they're dealing with everything from corporate finance to the consumer. It's going to weigh on them, and the risk of consumer debt and other things failing. And so, look, I think those are starting to fall apart right now too.
Tommy, the energy sector has been of great importance to the average investor this year because it's been one of the few performing sectors, right, in equity space.
Right.
Are you still involved in equities, or which way are you leaning in case?
I only have one energy long right now, and that's it's a natural gas position, and it was actually up today. We had on natural gas the futures DeMark buy countdown 13. So I looked at it and said I like natural gas better than I like crude. I still think that crude could move into the 60s. It's a tough trade right now because you've got a lot of people that are really, really adamant as far as wanting to buy crude right now. There's we have the Biden SPR refill trade coming up. As of now, we haven't seen any signs that he's planning on refilling it. So that's out there. The China reopening trade is out there. I'm not quite sure you want to bet too much on that. That could be choppy. But if we got into the 60s, I think that'd be good. I was long energy stocks for a while. I got out of them recently. I've been looking at the sector and just saying, I just want to be patient, and I haven't been able to, get anything on the sheets yet. I haven't pulled the trigger on any energy names, but I do think that the best time to own energy is late January through May. The seasonality is really, really strong, and I think that if we get a whoosh down into January, I think it'll be a really good setup for the spring.
Makes sense, Tommy. I had the chance to interview one of the most renowned energy economists from the Middle East for Real Vision. Dr. Anas Al-Haji is his name. He's Saudi Arabian. And I had a very interesting discussion with him around both the price of energy, but also the spillovers to energy stocks. So let's listen to Dr. Anas Al-Haji and get back to the discussion.
Generally speaking, when you talk about the oil stocks, generally speaking, there is a disconnect between the actual price and the oil stocks. So when oil was priced at 100, all stocks basically being priced out about $65 to $70. So that additional $30 is not there. And the oil companies, especially the smaller ones, opted for the fact that they want to distribute more money to investors. They are going to buy back stocks, and they are going to pay their debt. This is a very significant development, because if they pay their debt, in this case, and prices are high, then there is no need to hedge.
The entire interview with Dr. Anas Al-Haji aired today for our essential subscribers at the Real Vision platform. It's a must-watch from our great Make or Break series. But back to you, Tommy. We get a lot of questions coming in particular in relation to the price action that we've seen in Europe today. Very material price action in both bonds and equities in Germany, for example. So if our audience is sitting out there considering dipping their toes into European markets, do you have sort of a list of do's and don'ts when you start investing across the pond? What's your thoughts? What are your thoughts around trading Europe right now?
Well, I'm short the Euro Stoxx 50 right now, so I'll be clear on that. One thing to consider is the steepness of these drops. And when you see steep drops like this, it's probably ill-advised to necessarily jump in until you start to see a little bit of stability. And generally speaking, the stability, you can do it on very, very simple. I mean, it's not foolproof, but you can look at when the price moves above a 5-day or a 10-day moving average, and give yourself some time. And when it starts to do that, you can generally get an idea that it's starting to try and build some sort of base. It's even better when the moving average starts to turn higher with the price. So I don't think you necessarily have to be too early in on some of these. It goes for really just about everything. The way I look at markets. So I think right now it's going to be an interesting situation of how the follow through for the European markets after today will be. It's not necessarily the first day that really matters on the down move, but the forthcoming moves that happen, to see where the see where levels are, see what the type of intraday price action, to see if there's some stability. But I'm not a big fan of 1-day big drops and then V bottoms. It just, especially not in bear markets like what we have right now.
Tommy, you are a true fan favorite at Real Vision. We simply get so many questions, and please keep them coming out there. We have a question from one of our very loyal members at Real Vision, Ralph. He's asking you, consumer staples and healthcare, XLP and XLV respectively, look good to me. What does Tommy think? And are there any other areas that look good to him on the long side?
Oh gosh, that's a tough one right now. The other thing is, sometimes in bear markets, you don't have a lot of places to hide. And energy was, a pretty decent relative outperformer today in the U.S. Look, you've already had some pretty good moves in some of the consumer staples stocks. They may be priced out as well. I mean, I was looking I was in Clorox recently, and that's starting to break down. I don't have any necessarily where do I want to put money, just because I feel like we're at these levels that it's either make or break. Up 3%, down 5+%. So right now, I think that it's just I don't want to buy anything. I'm why? A lot of people are kind of like, why would you need to put risk on going into the end of the year, especially with lower liquidity, uncertainty, with just a lot of stuff. I like certainty, and if I can use my indicators to increase the probabilities of achieving some certainty, that's my goal. But right now, I think that look, you can be in Coca-Cola. It's a fine company, but that still could go down. I mean, that's kind of how I see it. I mean, I'm looking at it's not pretty. in consumer staples. So yeah, just be patient.
I can say,
Sorry, Ralph. I know. Call me Ralph. I'll hook you up with when I buy something.
I'll say to you, Ralph, I'm long consumer staples in a spread trade to tech. So at least you have my backing for that idea.
Okay, well,
We have a question from Derek on Twitter on home builders, and I remember a few months back we talked about your daughter buying a new home in the U.S., Tommy. So looking at home builders, Derek asks you, stocks look sort of extended for what is coming to the economy. Margins are likely to collapse to 2019 levels at the very least. Are their inventories even going to sell? And in case, at what price? What do you make of the home builder segment in the context of this potential upcoming recession and all that?
Yeah, they've held up really well, and I think it was, I forget who it was the other day, but Lennar came out with earnings. First, they were down a little, but the CEO and the management were sort of constructive that they could see a trough in margins the first quarter, and that's why the stocks reacted positive today. Another thing is the obvious that interest rates are starting to trend lower or have moved lower. So that certainly will help the home builders. You think about what's happened. If you have people, the majority of people, 60% of the country have mortgages. A lot of those mortgages are in the realm of the last 10 years with ultra low interest rates. Who's going to want to sell a house and maybe pay a little bit more for a house and then have a higher interest rate, because interest rates were up at 7% versus their 3% mortgage that they've had? That's a notable problem. So there's that mobility isn't there for people to upgrade to newer homes. So if mortgage rates and interest rates continue to go lower, which I tend to believe that's possible for now, then you're going to see the home builders catch a little bit of a bid, and you could see some people say, "Oh, I'm going to pull the trigger on buying a house." I think that's why those have performed relatively better over the last few weeks as rates have come down.
Tommy, we get a few questions on precious metals as well. And I don't know whether it's a part of the market that you used to trade a lot, but in any case, we have a question from Ina asking you, what's your opinion on precious metals and how do they look technically speaking?
Well, a lot of them, I mean, they've had a good run, and that's, they've run up with the idea that the Fed is getting closer and the ECB is, they didn't really factor in the ECB, what they were going to say today, which obviously didn't benefit the gold and silver and some others. But I think that they just got a little extended, and I think we're now in a place where you can buy pullbacks, and not necessarily just a pullback. I mean, gold was down 1.75% today. I don't think you need to buy today. I think you can try and pick some places in the beginning of the year. Gold also has a very good seasonal pattern right now as well. So look, if you can get gold to move down 3% more, maybe 5%, it could be a good opportunity to add that as a long position. But they just got a little overbought. Our sentiment indicators were telling us that silver especially was more overbought than gold. So yeah, I'm constructive on those, on pullbacks.
Makes sense, Tommy. Final question of the day. It's from Maximus on YouTube. He's asking us for thoughts on the US dollar in the context of both the Fed meeting and the ECB meeting today. You first, Tommy, and I may add a bit after that.
Okay, good. I need your backup on this. Well, what I think, what we've seen is we saw the dollar top with some DeMark buy or sell exhaustion signals. So we basically had the 13s higher, and now it's been trending down. We do have the DeMark sequential in progress on the downside. I think we're on day 9 of 13. It doesn't have to happen in exact order, but I do see the potential for it to move a little bit lower. Sentiment on the dollar, we use the daily sentiment index on our charts on the site, and the dollar sentiment was above 60% all of last year, and it finally broke recently the 50% level. And I like to say the 50% level, sort of like the RSI, when you break below it, the majority of people are bearish, and it's now, I think we had it at 23% yesterday. When you get down to around the, the teens and maybe even around 10%, that's getting very oversold. Now, sentiment is a condition, not a trigger. So we'll be watching to combine the DeMark signals and weak sentiment. So what's your take? And I think I have a good idea what you're going to say.
I mean, I've been short Eurodollar for most of the year, and I tried to resell Eurodollar just south of parity a month ago or so, and I obviously got stopped out pretty quickly. In relation to what Christine Lagarde and the European Central Bank said today, I think the vanilla reaction is correct. You buy euros on the exact statement, but as soon as you assess whether it's really a good thing for the euro that the ECB turns overly hawkish, then I guess as soon as you allow it to digest a little bit, the answer is no to that question, because I can assure you that after today's meeting, the Italian Prime Minister probably gave Christine Lagarde a call, and we will probably enter a period with turmoil in Southern European debt as a consequence of the ECB, first of all, hiking interest rates, and secondly, also announcing QT. We never really got to the point of QT during the last tightening cycle of the European Central Bank. So we don't really have any anecdotal evidence to look at or historical evidence to look at. But now they intend on doing QT from 1st of March next year. And let me put it like this, I have my doubts whether it's feasible. So I guess the bottom line is, with a bit of patience, you get a great chance to resell Eurodollar here. That would be my take, at least. And if we get close to 107.50, I would certainly be a seller up from those levels. Tommy, once again, a great pleasure to host you. Do you have any final comments that you want to sort of leave the audience with?
I'd just like to say thank you to everyone who's reached out to me over the last year. It's been a really good year for us here. I've really enjoyed the volatility as much as it's crazy. I sort of thrive on that. I want everyone to, put into perspective what we do in the markets. It's really a privilege to be investors. And I want to say happy holidays, happy Hanukkah, Merry Christmas to everyone, and Happy New Year. I'll probably be back. Maybe they'll grab me during, the middle of between Christmas and New Year's, because I'm always working. But probably I'll be back in January. And thank you to everyone at Real Vision as well. Thanks.
Happy holidays to you as well, Tommy, and see you in 2023. I don't plan on calling you between Christmas and New Year's, but I'm not going to guarantee it on air. Let me put it like that. So to sum up, I think it's crystal clear that Tommy and I agree that it's tricky to buy equities given what we've heard from central banks this week. But hopefully we get calm restart ahead of Christmas, because we all like a bit of family time around Christmas, don't we? We will be back tomorrow with Warren Pies guesting the show. But before I leave you, we have the meme of the day. And it resembles the meme I had yesterday with Jay Powell. So here's the slightly more tanned Grinch. I'm going to hike interest rates until you morons stop using more gas than we have. And I think that is the main takeaway from today's European Central Bank meeting. Thank you for watching, and see you tomorrow.